Hello and welcome to the Money Marketing Podcast. I'm joined today by Amy Kibblewhite, investment specialist at M&G. We are kicking off a brand new series looking at the fundamental shifts rewriting the rules of portfolio construction. So thank you so much for joining me today, Amy.
Thank you so much for having me. I'm excited to be here.
Great. So it might be an understatement to say that it feels like the world has changed. We've moved from a period of low rates and globalization to one of increased uncertainty. So from your perspective, what would you say has actually changed, and why do markets feel more on edge today?
Yeah, I definitely think understatement would be the right word because a lot has changed in markets. If we was to look back at kind of the decade post the global financial crisis, the characteristics of the environment were very much stability, low inflation, low interest rates, low volatility, and all of these things supported stable correlation between asset classes and broad market returns. As you say, now we've entered an era which feels like a lot more on edge. Markets feel on edge, investors feel on edge. And the backdrop is more so sticky inflation, very much not transitory as it was initially described, higher interest rates, more instances of geopolitical events, rising debt levels, and of course, the various implications of artificial intelligence as well. If you were to look at kind of the main asset classes, starting off with equities, particularly in the US, returns are increasingly being driven by a narrow group of AI-linked stocks, and high expectations are already embedded into those valuations as well. Beneath those relatively calm index levels that we're seeing, if you was to look at kind of year-to-date returns of various indexes, you may not see the volatility that we've seen, but actually, if you look beneath that, the dispersion between winners and losers in these areas is particularly high. And then if you was to switch to fixed income, the traditional safe havens are becoming less reliable. We've noticed that you can no longer consistently rely on your traditional safe havens such as US Treasuries, gold, the US dollar in the same way that investors used to be able to. But what I would say, Kimberley, as well, just to end, is that yes, the environment has shifted, a lot has changed, but also the predictability of markets has also changed as well. What we found is that central banks are no longer providing a clear roadmap to where they believe interest rates are heading. They've been burned by that in the past, so they're no longer providing that kind of expectation of where they think interest rates are going. And when you've lost that roadmap, what that leads to is volatility, particularly in the bond space. And markets are starting to feel unsettled and on edge, like you mentioned, because that roadmap has ultimately gone.
Yeah. And circling back to that, how this shows up in market behavior, what does it mean for diversification in portfolios?
I think diversification is becoming much more of a challenge. What I would say is that the importance of diversification has not disappeared. It is, of course, still a core concept of portfolio construction, but it's now something that ultimately doesn't happen by default. It has to be so much more intentional. And that is very much a challenge that advisors and investors are facing today. What we're seeing in this new era is very fast shifts in expectations. If we was to look back in January, markets were pricing in interest rate cuts, and now they're ultimately pricing in interest rate hikes. So the speed of which things are changing is drastic. It's not just small shifts in expectations, it's complete 180s, I guess you could say. And because of that lack of roadmap that I mentioned earlier, markets are very sensitive to every single data print that's coming out, whether it be inflation, payrolls, growth. Everything seems to matter more. And the key change for me as we look back kind of at the post-global financial crisis era compared to now is that both equities and bonds are reacting to the same thing, be it interest rates, be it geopolitical events. If we was to look at standard 60-40 portfolios, we're no longer seeing one part of the portfolio offset the other.
Yeah.
Actually, what's happening is things are reacting to the same drivers. And when this happens, that's when your kind of the traditional sense of multi-assets, be it 60-40, starts to break down.
Yeah. So, with that being said, what could diversification and resilience actually look like in practice today?
It's a great question, and it's definitely one that I can imagine advisors are finding challenging, investors are finding challenging. We're in a new era, so things need to change in terms of how we invest.
Hmm.
One part for me is, where else can we get diversification? So if you look at standard 60/40 portfolios, you've got 60% to public equities in the main and 40% to public fixed income. As we look forward, we need to be looking further than that. We need to be looking to asset classes that genuinely act differently to public markets. This is even more important when we're in an environment where the correlation between public equities and public fixed income becomes more positive on a more frequent basis. 2022 is an example of a year whereby the correlation of equities and fixed income became positive. And it was a year where your standard 60/40 portfolios, multi asset solutions struggled. We're in another environment whereby interest rates are higher and inflation is higher. So having asset classes outside of public markets, be it private markets, is so important. Private markets can mean a lot of things. And when we talk about them here at M&G, we refer to them as private equity, infrastructure, real estate, and private credit. When you're looking to build a diversified portfolio, you really need to look to start to include these types of assets within your investment proposition. What I would say as well is that apart from them providing genuinely differentiated sources of return, so these private markets actually supported our multi-asset solutions in 2022 as the private market area of the portfolio performed differently. The way in which you gain exposure to these private markets is so important as well. I would urge advisors, when they are listening to different sessions or different portfolio managers explaining that they can add private markets into the portfolios, it very much is the case, but the way in which they gain them is so important. Is it just in listed versions of real estate investment trusts or listed infrastructure vehicles, which, yes, provide that daily liquidity that a lot of investors are after? But at the same time, the diversification benefits aren't as strong compared to your unlisted versions of these types of asset classes, or even institutional kind of fund exposures like we invest into here at M&G or here at PreFund. It's really important to look at the way in which they're gaining that private market exposure. It's also a huge area of the market for retail investors not be able to tap into. I've got a couple of stats which I love to throw out in them. If you was to look at the number of companies in the US that are generating over 100 million in revenue every single year, over 85% of them are private. And then at the same time, the number of listed companies from the late 90s to now has almost halved in that time. So only investing in public markets, yes, you're not got as a strong case for diversification, but also you're missing a significant part of where the growth is actually happening as well. So adding those additional asset classes is really key. But just to end on time, I looked up actually what the definition of diversification actually is, and
Okay.
it's the practice of spreading investments across different assets to reduce exposure to any singular risk.
Hmm.
And we've got that first part, which is adding new asset classes. But the key is that secondary part as well, to ensure that those asset classes that you're adding or introducing to portfolios are not dependent on the same risk. You can have a very broad opportunity set, you can introduce more asset classes, but what's key is understanding the drivers of return for those asset classes that you're introducing to the portfolio.
Okay. And going off what you said and mentioned earlier, if multi asset doesn't guarantee diversification anymore, where should advisors be looking for risks?
Yeah, it's a really good question and point. And advisors need to start by looking beneath the bonnet of the multi asset solutions that they're recommending. I often say that no multi asset fund or no diversification is created equal. And it's really important to actually understand what's really driving the returns of the solution that you're recommending to your clients. What exposures does your client already have? Because what you often see is overlap across funds and exposures. It's something that's spoke about a lot in the investment industry at the moment, but what we're seeing at the moment is really high levels of concentration. A clear example and a well-known example of that is the US equity market. The Magnificent Seven account for roughly a third of the S&P 500. The top 10 stocks almost make up 40% of the index. Of course, these companies over the last few years have performed strongly. Clients will be extremely happy with the performance if they've got exposure to them. But as an advisor, if your goal for your client is diversification, is reducing reliance on any singular risk, can you really hang your hat, rely on multi-asset solutions that have over a third of their exposure to the US, where the top 10 stocks make up such a significant portion as well? It only takes a little bit of nervousness around tech, around AI. We've seen that more recently in terms of investors questioning the spend, and ultimately can demand match that. And we've seen a bit of a sell-off in the tech industry more recently. What's important is, can your clients afford to take that risk to have such overexposure to a small number of stocks or a sector or a region? Or more importantly, do they even know that they are? I think when we look at multi-asset solutions, they may look diversified on paper, but when you look beneath the bonnet, that's when you start to understand, are actually these exposures being driven by the same few underlying positions?
Right. And finally, how should advisors think about building portfolios and setting expectations with clients, especially in this time of volatility?
Yeah, we're definitely in an environment whereby volatility has started to become a bit more of the norm.
Hmm.
Un- Uncertainty seems to be the baseline. The number of geopolitical risks and events have definitely increased, that people are not becoming immune, but it's becoming less of a kind of spike up in volatility, as that volatility hasn't gone away. As I mentioned as well, that sense of there being a clear roadmap in terms of where we think interest rates are going to be, etc., really increases that uncertainty that clients and investors start to feel. For me, that leads really importantly and emphasizes the importance of being in a portfolio that's designed to navigate a range of outcomes and future scenarios, not just one. It also comes hand in hand with having confidence in the team that you're selecting to run your investment propositions, having faith and confidence in the process, and also the underlying investment philosophy as well. Because if you understand how a portfolio is built and why, then in terms of the conversations that you'll be having with clients, you'll be in a much stronger position to be able to explain to clients how their portfolio will behave in different market environments. You'll be able to say that, of course, there'll be periods like we've seen recently where more concentrated portfolios, for example, those heavily weighted to the US, will perform very strongly.
Hmm.
But when things change, and as we all know, things very much can change, then the experience for those investors may look very different. And if advisors haven't had that, or if they have had the conversation up front, it makes those periods of relative underperformance easier to understand and contextualize. Our role as asset managers is to work very closely with financial advisors to help deliver consistency of returns, firstly, but also provide peace of mind and clarity for our clients. I'd sum it up by saying that confidence in investing doesn't come from knowing what will happen next. It comes from knowing what to do, whatever happens. And that's exactly how we build and we manage portfolios here at M&G within the Life Investment Office, designed to navigate multiple versions of the future. And for our clients, real confidence comes from knowing that their portfolio is built to cope with whatever comes next.
Well, Amy, thank you so much for speaking with me today. It's a fantastic way to frame the rest of this series. So to our listeners, this is just the first conversation in our series exploring the new retirement landscape. So do make sure to subscribe and listen to the upcoming episodes. You can also discover how M&G, as the home of retirement, provides the products, tools, and support you need by visiting their website. So once again, thank you, Amy.
Thank you.
And see you next time.